Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 23rd of June 2020, and on Sunday we produced a video entitled Yield Curve Control, Another Way to Kick the Economic Can Down the Road, where we pointed out that central banks have a new trick up their sleeve for delaying what many perceive as the serious repercussions of the extremely high level of economic stimulus and money printing. Now, yesterday we did not produce a video as frankly markets were pretty uneventful and gold and silver prices moved but a little. However, it now being 22:45 GMT plus 1, we thought it appropriate to do a market update and attempt to evaluate where markets are moving from here and see if they are in line with our weekly update produced on Saturday. Well, firstly, equity markets have broadly been on a positive trek today, albeit modestly. The Dow Jones is up 131 points at 26,156. That's up 0.5%. The S&P 500 is up 13 points at 3,131. That's up 0.43%. And the Nasdaq is up 74 at 10,131, up 0.74%. So the Nasdaq percentage-wise performed best of the three. Now the Euro Stoxx 50 index closed up 57 points or 1.76%. FTSE 100 is up 75 points or 1.21%. The DAX is up 260 points or 2.13%, and the CAC is up 68 points or 1.39%. So the DAX index has performed better out of the European UK markets. Now, Asia-Pacific markets were up last night on average by 0.5%, and we are expecting, frankly, a similar rise tonight, though the relatively low performance of the American markets may not be sufficient to buoy Asia-Pacific markets. So much really depends on the geopolitical news as it is actually revealed this evening. Now, the dollar index has actually fallen today by 0.36 to 96.67. So again, falling below that important 97 level, and we were expecting it really to nudge up a little. So this is somewhat disappointing. And therefore, it would not be surprising to see that both gold and silver prices have therefore risen today, partly as a result of this weakening dollar. Now, gold is up $12 at $1,768, and silver is up 18 cents at $17.96, just 4 cents shy of that resistive but tempting $18 mark, though silver did breach it earlier today, actually touching $18.04. Now, we mentioned on Saturday that we expected both gold and silver this week to operate within the bands we set, but they would move within the upper echelons of those bands. And even though it's only Tuesday, we're witnessing decisive moves towards these upper areas. Now, today's gold price actually hit a new 7-year high. And softer than expected housing data announced today, plus signs of accelerated coronavirus cases developing in the United States, has certainly helped gold move higher. Silver too has tested the $18 level, and frankly, this price rise has also been encouraged by the rise in the price of gold. Now, much now depends on the dollar value, and better than expected European flash PMI data helped buoy other currencies at the expense of the dollar. Now, on that very note, there is an interesting article published by Reuters just yesterday, which should not be ignored or scoffed at, but should be taken with a degree of seriousness. It's not guaranteed to come about within the time frames mentioned, but one should consider it nevertheless. So let's take a look at what that article has to say. Reuters article dated 22nd of June 2020. Headline: Inflation dog may finally bark, investors bet. Gold, forests, property stocks, inflation-linked bonds. These are just some of the assets investors are pouring money into, on the view that the recent explosion of government spending and central bank stimulus may finally rouse inflation from its decade-long slumber. With the world economy forecast to shrink 6% this year, it may seem like a strange time to fret about inflation. And sure enough, market-based gauges suggest an uptrend in prices may not trouble investors for years. US and Eurozone inflation gauges indicate that annual price growth will be running at barely over 1% even a decade from now. So if inflation really is, as the IMF put it in 2013, the dog that didn't bark, failing to respond to all the central bank money printing unleashed in the wake of the 2008-9 crisis, why should investors prepare for it now, especially as demographics and technology are also conspiring to tamp down inflation across the developed world? The answer is that some think the dog really will bark this time, partly because, unlike in the post-2008 years, governments around the world have also been rolling out massive spending packages in a bid to limit the impact of the coronavirus pandemic. We will be pushing on the string and dropping our guard. Then 3 to 5 years from now, that's when the inflation dog will start barking, said Pinebridge Investments head of multi-asset Mike Kelly, who has been buying gold on that view. Gold worries about such things long in advance. It has risen through this coronavirus with that down-the-road risk top of mind, he added. Even typically frugal governments such as Germany have joined central banks with trillions of dollars in stimulus programs. Investors say even the long taboo topic of debt monetization, where central banks directly fund government spending, may be on the cards. What worries me is that at the moment it seems that there is no limit to fiscal stimulus, says Klaus Kaldemorgen, a portfolio manager at asset manager DWS, who said he was investing in inflation hedges far more now than he was after 2008. Inflation hawks also cite a trend of deglobalization, where shrinking international trade and Western companies bringing production back to their own countries leads to higher prices. This view, that inflation could pick up ahead, is reflected in forward swaps and in Citi's inflation surprise indexes, which show that the extent that US inflation readings are surprising against market expectations has been at record highs and has ticked higher in the Eurozone too. So what to buy? Investors have an interest in pricing future inflation correctly to safeguard their returns, hence the need for hedges, assets that increase in value or at least hold it when price growth accelerates. They appear primarily to favour US inflation-linked bonds and gold. Wealth managers, canvassed by Reuters, have been channeling up to 10% of clients' portfolios into the yellow metal via index funds, gold shares and even bullion. But if gold prices have risen 18% since the end of March, some other hedges remain cheap. US 10-year inflation-linked bonds, known as TIPS, show break-evens, or the anticipated rate of inflation in a decade, around just 1.2%. Also known as linkers, the face value and interest payments on these securities rise with inflation. But despite the stimulus boom, the inflation levels that are priced in are much lower than what was priced in at the end of last year, said Toyen Dreismar, a portfolio manager at Man Group, who is invested in inflation-linked assets. So inflation might be some years away, but banks are advising clients to pick up cheap hedges. Morgan Stanley suggests US 30-year linkers, while NatWest advises buying 30-year UK linkers and 10-year Eurozone inflation swaps. These hedges, in many cases, look extraordinarily cheap, so why not buy them now? We could wait, then things could start to move away from us, said Colin Hart, multi-asset portfolio manager at BNP Paribas Asset Management. Indeed, the S&P 10-year US TIPS index is already up 12% from March levels. It won't be a couple of years from now until inflationary factors start to come through, So that's why we keep long-dated US linkers, said Chris Jeffrey at Legal & General's asset allocation team. Hart at BNP said his main hedge is gold, but he's also invested in a broader commodity basket, which includes natural gas, copper and oil. And it's not just about gold or linkers. Another choice is real estate. Kalt Morgan of DWS is buying German residential property stocks, betting that the supply of new property will rise slower than the money supply. Global house prices adjusted for inflation rose 14% in 2009 to 2019, according to the IMF. Legal & General's Jeffrey accelerated investments in agricultural land and forestry earlier this year in expectation they will retain their value over the 5 to 10 year horizon. His holdings are via publicly listed shares of companies heavily exposed to such land. Timber prices rose over 130% in real terms in Great Britain over the past decade. Forest research data shows while the value of US farmland rose 28% in the decade to 2019, according to the Department of Agriculture. Kelly of Pinebridge also favours timberland purchased through private funds. While predicting that linkers will remain cheap for the next few years, he expects timber to benefit sooner if rock-bottom mortgages entice more first-time home buyers and fuel a construction boom. End of article. So, inflation is yet regarded as being a number of years away. But as the article suggests, investors are preparing now, which is why we've seen the recent rise, particularly in gold prices. We're more concerned, short-term, with the huge amount of US dollar printing, and with an election due within less than 5 months, we can expect to see even further stimulus measures being adopted, resulting in a further undervaluing of currency levels. This alone will ensure that precious metals will hold close to current levels as a sort of baseline, for the want of a better expression, and continue to rise over time. Notwithstanding, of course, any other major geopolitical issues that may rise its head. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.